Welcome back to Yahoo Finance Live. I'm Julia La Roche, and I'm pleased to bring in our next guest, Starbucks CEO Kevin Johnson, fresh off the coffee chain's record fiscal third quarter results. Kevin, always great to have you on the program. And I was just mentioning a record quarter for you all, hitting $7.5 billion in revenue during the quarter for the first time. And certainly I was sensing quite a bit of optimism for you as it relates to not just that you all have recovered, but that you see this tailwind, this multi-year tailwind in the years ahead. Where are you getting the confidence from?
Well, Julia, good morning, and thanks for having me on the show this morning. Look, this was a record quarter on just about every dimension. You pointed out we beat revenue consensus and posted a $7.5 billion quarter. We beat a significant beat on earnings per share. And if you look across our major businesses, our U.S. business, 2-year growth is 16%, 2-year growth. So we're growing over fiscal year 19 at 16%. In China, that 2-year growth is 23%. So you look at it on every dimension. We're growing. Customers are back in our stores, and so that's what's given me great optimism. The new stores we're building in China are performing better than prior generations. Our comp is accelerating and growing in the U.S. and China. And our channels business has put us in the #1 share position in ready to drink and packaged coffee. So you put all of that together, and it just says that, as we come out of this pandemic, we have further differentiated the Starbucks experience relative to other alternatives. And I think the combination of this large and growing addressable market for coffee, the continued shift to Arabica coffee, and the Starbucks differentiation gives us a multi-year tailwind. And I think we're seeing that unfold.
So many things I want to dig in with you. Kind of speaking of trends, one that was really surprising to many folks, Kevin, 74% of your total beverage sales are coming from the cold beverage platform. Is that something that you had ever envisioned or expected? And what is kind of driving that?
Well, Julia, I think it was probably a little over 4 years ago at our investor conference. We made the comment that we thought, going forward, that we would soon see over 50% of our beverages be cold beverages. And what's driving it is innovation in our beverage platform, starting with cold brew and the nitro cold brew, and now our ice shake and espresso beverages and our refreshers. So these are all coffee-based cold beverages. And I tell you, customers love them, and especially the millennial and the Gen Z cohorts, they really enjoy those cold beverages. And so that is really a big part of what's driving growth in terms of the platform, is the fact that we have these personal handcrafted beverages, both hot and cold, that customers love.
Yeah, probably the fact that you all are able to customize them at that level. Another area, of course, of growth has been the alternative milks. I think you said accounting for 25%. Just really quickly on the alternatives, because a lot of folks will want an update. What is going on with the oat milk situation and the partnership with Oatly?
Well, we've been on this journey to give customers choice when they look at the milks in their beverages. And we've expanded a number of alternative milks: soy, coconut, almond milk, and with oat milk in our partnership with Oatly, significant customer demand for that oat milk. In fact, we've added some other suppliers, and Oatly, I've been working with their CEO. They're building an entire manufacturing plant in Utah just to keep up with the demand at Starbucks. And so, we're optimistic that, we're getting the supply side of the equation in order, because the demand is going to be very strong going forward. And that's good, because it's not only good for the planet, but it's also good to be able to serve those customers who prefer those alternative milks.
Mm-hmm. And I do also want to bring up digital with you. More than 24 million active members, which you said represents 51% of the total spend here in the U.S. Kevin, help us contextualize that, why it's so critical, that digital ecosystem, and where you want to see that go. How do you kind of think about the growth there, the addressable market, and how valuable those customers are compared to folks who are the non-rewards customers?
Yeah, I think the first thing to realize is that the two transformative elements of modern day retail are, number one, creating a great experience in your brick and mortar store so that it's a destination for the consumer, and then extend that experience with digital mobile relationships. And that's exactly what we're doing. In fact, as we started this fiscal year, we had 19 million active rewards members. This is 90-day actives. We've grown that now to over 24 million. And when customers join the rewards program, it increases their engagement, their frequency, and their spend. And it also allows us to have a more personalized relationship with them. And this is where our technology like Deep Brew personalizes the suggestions and the recommendations and even the offers that we make to those customers. So it really strengthens the loyalty and the relationship between Starbucks and our customers. And so, we said earlier this year, we had this vision that we could double the number of active rewards members in the US over the next few years. And you see, we've already gone from 19 million to over 24 million. And candidly, China's seeing the same thing, Julia. We went to over 17 million active rewards members in China. And that was nearly double where we were a year ago. So significant growth in the digital customer relationships.
I know there's so much to discuss. Another key topic, inflation, the inflationary pressures you all are seeing. Where are you seeing those? Is it across your supply chain? Is it the wages, coffee prices? How are you kind of thinking about inflationary pressures, how you want to mitigate those, Kevin?
Yeah, well, first of all, I think as we're seeing across the market, everyone's dealing with some inflationary pressures. For us, part of this is we want to continue to increase our investment in our Starbucks partners who proudly wear the green apron. And this is through wage and the total compensation package that we have for them, wage and benefits. And we made a very positive step forward as we entered this fiscal year. We're going to continue to make investments in our partners. And so that's number one. That's a key investment that I think of, and we know that we make that investment, our partners rise to the occasion and they create that great experience for our customers. And so that's a good thing to invest in. There's some inflationary pressures on the supply chain side, but not as it relates to green coffee, simply because when you think about the way we buy green coffee, we purchase our green coffee 12 to 18 months in advance. And so right now we're price locked for more than 14 months going forward. So we've basically purchased and price locked the green coffee we need for the rest of this fiscal year and most of fiscal year 22. And I think we're one of the few buyers that buys that far in advance. We warehouse that coffee and we do everything we can to take care of farmers so that when there is a spike in the C price, as we're seeing happening now due to some of the weather in Brazil, we can sit back and not be forced to buy green coffee at this particular time, wait till the price is more reasonable. And that gives us some assurance that we can navigate the C price and that element of inflation. But there'll be some other pockets in supply chain where some of our suppliers, they too will be increasing wages and some other areas. But I think it's all manageable. In fact, we can use a combination of price, but also operational efficiencies in our stores to offset that. And even with the inflationary pressures we saw this last quarter, we expanded operating margin. So, I think this is something that we have well in hand and we know how to navigate. And I don't foresee that being an issue for us going forward.
So you're not too worried that we're going to see higher prices as consumers at Starbucks, sounds like.
Well, we use price. We've had a pricing strategy, and we're very cautious in how we use price and very strategic. And we're going to stick to that strategy going forward. And I think that has served us well. But we have other areas in addition to price to offset any inflationary pressures that we might be feeling.
Let me talk to you about labor, because kind of broadly out there, we've seen a lot of companies kind of in the restaurant sector, if you will, kind of raising wages, giving signing bonuses to kind of bring people in, because it's certainly been hard for them to attract talent. I want to go back to this time last year when we were talking, you were honoring benefits, paying wages, increasing wages for those who were working and whatnot. You really kind of talked about making this investment in your people at the time. Did that investment pay off, Kevin? And how are you thinking about the talent that you have been able to retain and attract?
Yeah, Julia, if you recall through the pandemic, we made the decision to give our partners economic certainty. And that meant we paid them whether they came to work or not. And we avoided any involuntary layoffs or furloughs. And in many ways, that built trust with our partners. And in turn, they have risen to the occasion. And so, the big part of the reason this is a record quarter is because of those partners and how they've responded as customer traffic has increased in our stores. And so, we're very grateful for the role that our Green Apron partners play, and we built trust with them over this last year. And so, as a result, we've been doing just fine having enough staffing in our stores. There's pockets where we have to continue to hire. We have had to make investments to help some of our suppliers ensure that they're hiring the talent and the staffing they need to keep up with demand for things like breakfast sandwiches and some of the things in our pastry case.
Mm-hmm. And I also know you as someone who looks closely at the data. I would also kind of go back to last year. You all were the first to, require masks in the stores because you were following the virus so closely. What are you seeing as it relates to the Delta variant? Do you see a scenario where folks might have to start masking up again? Curious what the data is showing you.
Yeah, well, Julia, we've got the three principles that have guided us through this entire pandemic have led us to create the store protocols that allow us to dial up or dial back the safety protocols as this virus is mitigated and contained. And the good news is we have a solution for all of this. It's called vaccinations. And so, as more people get vaccinated, we've seen customer mobility increase. And, certainly with the Delta variant, there's questions about the safety of having everyone wear masks indoors. And in states and cities that they mandate that, we will follow that. I think certainly we take the lead from the CDC and what local health officials prescribe. I think wearing masks that shouldn't impact the growth that we're seeing and the trajectory that we're on. In fact, I even had the team look at at certain geographies where the Delta variant was spreading more rapidly and where vaccination rates were lower. And even in those geographies in the U.S., their same-store comparable numbers were at or above the national average. So I don't see the spread of Delta variant or other things impacting our business. We may and we will follow local guidelines on masks, and we'll adapt, and we know how to do that. And that's part of the muscle we've built here over the last 18 months as we've navigated the pandemic.
Mm-hmm. And let me bring up China with you because you all have now surpassed 5,000 stores in China, certainly plans to continue opening there. Just kind of noticing, though, the comparable store sales they increased 19%, driven by 30% increase in transactions, but partially offset by a 9% decline in average ticket. You also did issue some guidance there for comparable sales growth of 18 to 20%, which is lower than the previous guidance of 27 to 32%. Help us contextualize China and that market for you all and the importance there.
Yeah, look, the overall market in China grew 23% over a 2-year period, and same-store comps in China grew 19%. So they accelerated over prior quarter. And the reason you see ticket coming down slightly is because there's fewer group orders. As customer mobility increases and more customers are visiting the store, there's fewer group orders. And so you see ticket moderate a bit as transactions increase. When we look at the 2-year comp in China even accelerated. And that's recognizing, too, that, with international travel restrictions in China, some of the stores that we have in airports, especially in the international terminals, are closed. They're still in the comp base, and those will actually, they'll do just fine once we reinstitute international travel in China. And then in some of the cities where they've had to do quarantine so they could test citizens in those cities, we've closed stores for a few days in there. But even with that, we saw acceleration in same-store comparable, and our 2-year comp numbers look good. So we're feeling good about that. Most importantly, though, Julia, we opened over 125 or so net new stores in China this last quarter, and they are performing at higher AUV and profitability than prior generations. So the brand is strong in China, and we continue to be very bullish on the long term.
Well, Kevin Johnson, CEO of Starbucks, thank you always for stopping by. We'll see you next quarter.
Mattel clobbered analyst sales and profit forecast powered by many things like Barbie and Matchbox and, of course, Hot Wheels. The company also laid out some very bullish guidance for 2022 and said a new Barbie movie will go into production in 2022. Shares are higher this morning in response. Joining us now is Mattel's chairman and CEO, Ynon Kreiz. Ynon, always good to see you here. Why no slowdown in your business quarter over quarter, given that we are all mobile again, maybe, or we would have thought we're not out there buying as many toys as we were? Why do you see that?
Well, hi, Brian. Let me give you a bit of context. First of all, let me say that these are exciting times for Mattel. We had another exceptional quarter. We exceeded expectations with sales up 40% and adjusted EBITDA growing by more than 4 times. Our strength is foundational and broad-based, and we're significantly outperforming the industry and gaining market share in each region. We are now firmly in growth mode, and our top-line performance is adding momentum to our transformation strategy. As you said, we do expect to continue growing for the rest of the year and achieve double-digit growth in sales for the full year with high growth in profitability and cash flow. So a lot of momentum, and we believe we are now in the strongest position we have been in many years to improve profitability and accelerate top-line growth.
That's a change in tone from you. We've talked in the past, and it's more been about transforming Mattel, but now you're telling investors we're a growth company. What are some of the brands that will drive that growth for the balance of this year?
Well, that's right. We are now in growth mode. We finished the heavy lifting of the restructuring and are now seeing tremendous momentum, now growing for 4 quarters in a row, double digit. We've also have grown market share for 4 quarters in a row. So the momentum is broad-based. It is comprehensive. We saw growth in every region and in all of our reported categories, as well as in 3 power brands and American Girl. So you're seeing momentum in Barbie, Hot Wheels, Fisher-Price. Our power brands are growing all double-digit with momentum across the board, which is why we're so confident in the momentum heading into the second half of the year, as well as 22 and 23, where we already said our goal is to achieve growth in those years as well.
I definitely want to dive more into your plans for by brand, but Ynon, you mentioned you threw out a very big number last night on the earnings call. You expect to achieve $1 billion in adjusted EBITDA by 2022. Now, some of the estimates I've seen out there on the street range from $700 million to $800 million, so your guidance is pretty significant. Why do you think that gap exists between what you're looking for and the street's looking for?
Yeah, look, first of all, we also raised guidance for this year significantly. We effectively doubled our guidance for to sales growth to 12 to 14% and increased our guidance for adjusted EBITDA by $75 million to $875 to $900 million. And seeing the momentum that is in the business, we do expect to exceed $1 billion of adjusted EBITDA in 2022. It is driven by momentum across all categories. We are growing market share. And as I said, this is not just one region or one category or one brand. It is broad-based. The strength is broad-based. And with that, we have the confidence to give that guidance to investors.
Big guidance for 2022 in terms of operating profits exceeding $1 billion. As you just mentioned, you now say you're a growth company. Are there plans to put a dividend on the table and also a share repurchase program?
Well, we made tremendous progress on our balance sheet. We brought our leverage ratio down to 3. This quarter, it was 8.4 just a year ago at this time. So a lot of progress on the balance sheet. And with that, we will have optionality. We haven't been specific about what we will do with the excess cash that we will generate. But the key message is that optionality and whatever we do will be to create value for our shareholders.
Are you leaning one way or another?
No, we will look at all the options. You know, we have different ways to drive growth and to create value. The company now is in strong place, and we're seeing momentum, as I said. So that will create opportunities on the business side, on the balance sheet, and we will do the right thing by our investors.
You talked a good bit about, on the earnings call last night, about potentially or looking to raise prices later this year. Where are you taking those price increases, and what's causing them?
Yes, we already implemented price increases, and this will come into effect in the second half of the year. It has not yet played out in the second quarter, but you will see that in the second half of the year. We always have consumer in mind, and we aim to find the right balance between quality, safety, and value to consumer as we're thinking about our pricing strategy. And we believe we have the right equilibrium, and we will not, we don't expect that to impact consumer demand.
I was thinking about this morning, Ynon. When I'm in Walmart, I have been known to pick up a few Hot Wheels cars. They're very affordable. I have a whole collection of them, full and fair disclosure. But do you have to be careful with price increases? That is a very price-sensitive category. It's affordable. It's an opening price point category. It focuses on a lot of consumers that are, in fact, price conscious. Do you have to be selective where you can take those price hikes?
Of course, you have to be conscious, and this is exactly what we do. And as I said, we always have consumer in mind. We find the right balance, and we will continue to do that going forward with our pricing strategy.
Before we let you go, Barbie is going into production in 2022. What type of toys are you going to build around that movie? Are you looking at a complete refresh of the Barbie line?
Well, as you said, the Barbie movie is going into production next year and will release in 2023. Greta Gerwig is now also confirmed to direct as well as write. Margot Robbie will star as Barbie. It's a great package, great creative package. We haven't been specific about what line of product will accompany the movie, but it is going to be exciting. The movie will be exciting. The Barbie is always exciting and continue to go from strength to strength. Still #1 doll property year to date, and of course in the second quarter. So a lot of momentum behind Barbie, and we're very excited to see how this will play out.
Well, full disclosure, because I know my team is going to ask me this, the last Hot Wheels car that I bought was in fact a Tesla, because why not? Mattel Chairman and CEO Ynon Kreiz, always good to see you. Stay safe. We'll talk to you soon.
Thank you, Brian.
Welcome back to Yahoo Finance Live. We are seeing shares of Mondelez slipping in this session right now, down nearly 3%. On the back of its quarterly results, out yesterday, the company behind Oreo and Ritz earning 66 cents a share on revenue of $6.6 billion. We did see the company raise its revenue forecast with a big bounce back in emerging markets. Let's bring in the CFO of Mondelez. We've got Luca Zaramella. We've also got Yahoo Finance's Julia La Roche joining in on the conversation. Luca, it's great to talk to you today. Certainly a strong quarter here, especially with EM seeing a bounce back there, but there's a lot of concern right now overall about cost and inflation. I wonder if we start there, what you're seeing from your perch on that front.
Thank you for having me, and good morning, everyone. Well, inflation is clearly on the rise, not only in the US, but in many places around the world. It revolves pretty much around key commodities for us, and they have been on the rise since the beginning of the year. We have been favored so far because we had long coverage, and so some pressure is going to come into the P&L. Besides that, logistics costs are on the rise, and obviously labor. We still have a captive system in the US in terms of distribution and delivery to stores, which we call the DSD system. And so we are somewhat insulated, but given the high demand that continues, we are still facing some headwinds, particularly in terms of logistics cost and labor costs as well.
Luca, Julia La Roche here. Of course, the big conversation for a lot of companies has been those inflationary pressures. Just curious, from maybe a pricing standpoint, what kind of elasticity do you see for you all when it comes to pricing, and what might consumers expect across your portfolio?
I would start maybe by talking about what we call cross elasticity. This is clearly unprecedented inflation in some places, specifically in the US, and obviously, we expect prices to go up and to continue to rise potentially for a certain period of time. And so I think importantly, the relative level of our prices compared to others is going to stay unchanged. And I think consumers somewhat are getting accustomed to higher prices as well. In terms of elasticity, it is fair to say that our brands have been favored compared to others. And so people are still looking for comfort around snacking, and they tend to favor big brands and brands they can relate to, like those that we sell. And so I expect in terms of elasticity, not a big impact. On top of that, we are pushing forward what we call revenue growth management, which is about not necessarily moving price points, but offering multiple sort of solutions in terms of pack sizes, etc. And so that capability that we have to ensure we don't vacate price points and we keep certain critical price points is something that has to be kept in mind in terms of mitigating the impact of elasticity.
And certainly the results have shown strength in the first half of the year. And I was wondering, Luca, what kind of data do you all have around the share gains, specifically, the penetration that you all have made, new customers, and the retention of those new customers? I remember about a year ago having the conversation with you all with kind of people revisiting these brands, if you will. How have you kind of seen the retention play out?
The retention is quite good, quite frankly. Last year, when, in the middle of the COVID crisis, we as a company executed very well around the world. There was a part of a share gain that was related to our ability to execute better than others. But as I look back and I say, how much share have we gained last year at this point in time? What I can tell you is that we are retaining 3/4 of those share gains, and they were material and they were broad-based. And so the continued investment in our brands, that is the core part of the strategy, is paying off. And I have to say, so far we are happy and anticipate that we will retain those share gains for the remainder of the year.
As Akiko mentioned, you had emerging markets play a pretty crucial role in the quarter, up to $2.29 billion, 20% higher than last year. I mean, when you think about how the U.S. is different than those markets now, especially in the pandemic, I mean, what's the driving cause to invest there? Is it logistics constraints, concerns that we saw around the pandemic? What's going on there, and what can you point to as continued strength next quarter?
So the US last year had a terrific quarter in Q2. We grew after a Q1, again, double digit. And so we're lapping elevated demand. For us, the North American business closed flat to last year, which means we are retaining those levels of high demand. In emerging markets, on the opposite side, particularly in places like India, last year there were material lockdowns that impacted the revenue base. And so we are lapping that. But reality is, whether it is the US or emerging markets, what we see is an elevated demand level compared to 2019. And that is to testify that, again, our brands resonates well with consumers, and that in tough times, people tend to find comfort in snacking, and our brands are there with them. And again, chocolate and biscuits specifically, as I look at the category, the numbers are terrific. And so we are very happy with the elevated demand, both in developing markets and developed markets.
Look, I probably found a little bit too much comfort in the number of Oreos I've eaten in the last year, but I do want to bring up the impulse channels, which we know a lot of the on the go snacking, it really suffered during the pandemic, specifically things like candy and gum. What are you seeing in those spaces right now?
It is absolutely true that consumption on the go and convenience channels and impulse channels have been more impacted than others. And obviously, mobility rates being down versus 2019, they impact mostly gum, which is an out-of-home consumer habit. We see the category still trailing versus 2019. As I said yesterday during the call, it is still 80%, so not a great number. But reality is, as mobility improves, we start seeing improvements. And so my hope is that towards the end of the year, the situation will be much better. Having said that, I don't expect necessarily the category to go back fully to the level of 2019. In that context, we are executing well, we are investing in our brands, and we are gaining share. But again, reality is the category is not where it should be. And I'm not sure, even with mobility constraints being lifted, the category will ever go back to the levels of 2019.
Luca Zaramella, CFO of Mondelez, it's great to talk to you today. And our thanks to Julia La Roche as well for joining in on the conversation.
Welcome back to Yahoo Finance Live. I want to focus in on the Olympics, as we've been discussing, shaping up to be an early disappointing start for NBC and Comcast, at least in regards to ratings so far off by about 40% relative to what we saw in Rio, at least at the beginning of the games. And the headlines coming out of it have not necessarily helped the idea that we could see a turnaround after Simone Biles pulled out of the team gymnastics competition. And we also saw just a few moments ago also pulling out of the individual all-arounds as well. Some big-name athletes also in there. Tennis star Naomi Osaka getting out of the competition after she lost. So there's a lot of different things here, at least in terms of the big stars, weighing on the expectations that more people will be watching the Olympics. And for more on that, I want to head out to Tokyo. We've got Chris Smith staying up late to join us here, Sports Business Journal writer extraordinaire, now on the air with us. Chris, appreciate you taking the time, man. I know it's late. But when we look at it, not the spot that NBC and Comcast wanted to be in, already, according to Variety, having make good talks and trying to sweeten the deal for advertisers. But what's your take being there at the games and how this is all shaking out?
Yeah, I think it is one of the major storylines so far. Everybody expected that ratings were going to be down a bit, right? We've seen ratings down for sports throughout the pandemic. I don't think that it was a surprise to see that the numbers would be down, but nobody expected them, I don't think, to be this far down. You pointed out, obviously, star power has been a big issue. We've seen, obviously, Simone Biles now pulling out of the all-around on Thursday. Naomi Osaka got bounced. Some of the other athletes, Katie Ledecky didn't dominate like she has in the past. Nyjah Houston, the best skateboarder in the world, didn't sniff the podium. And I think, a lot of viewers are watching to see the United States dominate in the Olympics. And so when it's not happening, some of that shine comes off. When there's no fans in the stand, some of that shine comes off. And so I think it creates a very challenging position for the broadcasters.
I mean, what does it mean for NBC? When you think about why the Olympics move forward in the first place, you could argue from the IOC perspective, from those who are broadcasting, there was a business decision that was made to make good on what they had sold. What does it mean for NBC as they try to sweeten the deal for those advertisers who say, look, we're not really getting our money's worth right now?
Right. So, NBC is obviously going to be doing everything it can to drive up engagement. One thing I will note is while overall ratings are down, and that includes streaming, a lot of the digital numbers and streaming numbers are improving. And we've seen engagement numbers, they have reported record high numbers on Peacock and some of the other streaming and digital platforms that they have. I'm sure that's something that they're going to be trying to sell to advertisers to say that, we are reaching viewers. It just might not be in the traditional way that we're used to. NBC will also typically have had some ads that it hasn't sold, right? Some ad inventory that they can provide to their advertisers as a bit of a make good to say, we didn't hit the numbers we promised you. Here's a little bit of, what you paid for back. We'll take care of you to make up for that difference.
Yeah, 648,000 viewers per minute earlier in some of the competition days here for their digital platforms. That was a new record, so there is that. At the same time, though, in context of other things that advertisers could be looking for, this is definitely the biggest thing on air right now, and still delivering on that by far. When you look at maybe how it could help in terms of signing people up, obviously the digital strategy, as you're talking about, they're rather important for NBC, trying to get people to get to Peacock. At the end of all this, maybe we would be focusing on the wrong things just to talk about ratings. How do you see it shaping up for their overall digital strategy in making sure that people stay after the Olympics?
Yeah, that's the great question, right? Obviously, things are moving towards streaming. Things are moving towards these digital platforms, Peacock being the one for NBC. That is their future. And I think the fact that they're driving people that way is a good sign, right? Is something that is good for them to have people engaging there. And more broadly too, right? You talked about how, people, the numbers are going up there, and it's not just with NBC. Twitter reported that the volume of tweets is up something like 165% since the start of the games. The International Olympic Committee has reported that their digital platforms have over 2 billion engagements so far. And we're less than a week since the opening ceremony. So I think there are some indicators here that people are engaging, right? People want to follow the games. They want to talk about the games. It just might not be through those typical vectors of measurement that we have, right? The ways that we look at ratings or TV viewership numbers.
And Chris, we've heard so many of these athletes allude to this very unique environment they're competing in, really adding to the stress of it, the empty stands, no spectators. You're out there yourself. Walk me through what it's like. You're at a stadium that's completely empty with these athletes trying to compete. How do you think that weighs on the environment?
Yeah, it's a challenge, and I think it varies quite a bit from sport to sport. It's interesting. I was at the 3-on-3 basketball tonight, and there were actually a lot of cheers and a lot of, shouting in the stands, because you do get some, National Olympic Committee staffers and support staffers who will kind of fill up some of those seats. At the same time, I was at the USA basketball game earlier today, the 5-on-5 against Iran, and the place was a ghost town. You know, you could hear a pin drop, and you could clearly hear the piped-in background noise that they were filling in through the PA system. So it's very much varies, I think, event to event. But you're right. You know, you are an athlete at the top of your sport. You are accustomed to having jam-packed houses screaming your name, you know, to have that motivation, to feel like, you know, you're doing something people care about. And now you go out there and there's nobody there, right? And you feel like you're all alone on that stage. And, you know, that only adds to the pressure, and, you know, as if there wasn't enough already at the Olympic Games. So I think there's a lot of challenges here, you know, not to mention, you know, I think we'd be remiss not to mention the various stresses involved with COVID protocols. I can tell you, coming in, just getting into the country was an absolute nightmare, you know, for myself and for all of these people. You know, I saw all these athletes in the airport, you know, sitting there waiting for some Tokyo staffers to come over and make sure the apps on their phone are working right, to make sure that the paperwork is right, to make sure that the COVID tests are all, you know, aligned and processing. It was a lot to go through, just hours and hours and hours. Then you get into the country, you're getting tested every day. You're in a position where you can't leave the village, you can't interact with people. It's just, you know, very restrictive, very stressful. And so I think, you know, we were talking about Simone Biles before. You know, I think it's very easy to understand why she's in the position she's in because of all those stressors, I should say. And, you know, and that just creates, you know, untold level of challenge that they're facing.
No, it's absolutely right. And you got to do all that. I mean, everybody out there watching right now probably feels the stress of the pandemic stretching on this long, but then also getting asked to go out there and fly around in the air, endangering yourself if things go wrong. Not hard to understand all of it. But Chris Smith, even you, all the stressors, and now staying up late to come on the show with us. Appreciate it, man. Chris Smith, sports business journal writer. Thanks again for taking the time, and good luck out there, man, with all the coverage.
Thanks.
I want to stick with the latest on COVID and the vaccine push and welcome in Dr. Manish Garg, emergency medicine physician and co-founder of World Academic Council of Emergency Medicine. Dr. Garg, always good to see you. So, you know, you just saw Alexis rattle off all of those measures that municipalities are taking, that private companies are taking. When you look at these new recommendations now from the CDC, in hindsight, did we reopen our economy a little too quickly?
So thank you, Alexis, and thank you, Kristin, for having me back on the show. Great to see you again. Just for transparency purposes, the thoughts are my own, and I have no conflicts of interest with pharmaceutical industries or vaccine developers. Yes, Alexis, to answer your question, I believe that the recommendations that were made originally were appropriate because as this virus has evolved, so must our public health recommendations. And previously, when we had the Alpha variant, which is the variant that came from the United Kingdom originally, that was not shown to have transmission once you've been vaccinated. Now, the Delta variant is showing that you have transmission once you've been vaccinated. And when we look at the CDC map that was just shown, it's showing that about 2/3 of the counties of this country are in either what's called the high or the substantial region of transmission risk. So that is a real big concern. And I think that the current recommendations follow one, global health recommendations like WHO, two, shared experience. So I can personally speak as a physician who's been working in 3 different hospitals in New York City. I'm seeing a number of breakthrough infections happening, not just in patients, but in my colleagues. And you can imagine my colleagues are the ones who are probably protecting themselves the most. Now, these breakthrough infections are not leading to deaths, are not leading to intubations or ICU stays. But that's where the vaccines protect us. But it's important to know that you know, when you follow science, the science is clear that the masks, you know, work, vaccines work, and we need to evolve our public health recommendations as this virus evolves.
Doctor, what about booster shots and perhaps even that third vaccine shot? One, we are seeing Americans out there that are choosing to try to mix and match essentially vaccines. So on the flip side, we have folks refusing to get vaccinated. And then on the other, those that are apparently just driving around trying to get extra shots. Is this something that folks should attempt to try to get an extra shot? Or do you think that booster shots are absolutely needed, at least by the fall?
So this is a really complicated question, Kristin. I would say that boosters are going to be necessarily for those that are the most vulnerable. So those who are either immune suppressed or immunocompromised. And I think that that's where we're going to see this eventually go. Right now, we know that if you've been vaccinated with any of the vaccines that are currently available in the United States, so the Pfizer, the Moderna, the J&J, you are going to be protected from the worst possible outcome, which is the intubation, ICU admit, death. And I think that's the key point here. But as we all know, this virus still does a number on people who've been infected and have even a breakthrough. So we are seeing that this has become a pandemic of the unvaccinated. And there's a large chunk of people that are still unvaccinated. And unfortunately, in that group, they need to take all the precautions necessary. We know that the boosters, we know the vaccines, if you do mix and match, they do work, although obviously at this point, that's not being recommended. So I think in the fall, as we start to, hopefully we'll get clear evidence for the big swath of people that are unvaccinated, which are the children that are under 12. Hopefully they will get, the data will be there that they can get vaccinated, and then they will be, and we will be looking at a much better experience. But right now, as we continue to develop more variants internationally and as they come our way, it looks like boosters are going to become a reality.
You know, Doctor, there have been some critics, even in the medical world, about vaccinating the very young, those under 12, saying that it's not a move we should make since the virus doesn't seem to affect them in really bad ways, meaning there are very few hospitalizations and very, very few deaths. What would you say to those people who say they should take precautions but should not be vaccinated?
Yeah, this, Alexis, is a great question, because right now we do know that children that are under the age of 12 are having, they seem to, when infected, seem to not have the worst outcomes. But right now, over 20% of the infections that are happening in the unvaccinated are children. And so, unfortunately, children may end up becoming the folks that are spreading it to those who are the most vulnerable in our communities. And, you know, right now we all have different bubbles. We all have different people within our household that may have a different type of immune risk. So if you have somebody who is immune compromised, somebody who's immune suppressed, your child might not have a severe response to the COVID, but your loved one might, the one who's not protected might. So, I mean, I think you have to look at this as a public health measure and say that we're trying to protect our most vulnerable, and we don't want children to be the vectors of that. I don't disagree with folks that are saying that children have very little outcomes and that it could be worse driving in your car than it would be for your child to get infected. But the virus is still novel. We don't have long-term data on what happens to children if they do get coronavirus. We know that you can get multi-inflammatory syndrome in children, and we certainly don't know the long-term effects if kids do have a bad outcome. So, you know, I think it all depends on what a person or family's personal risk is. And if you have children that certainly are at risk, or if you have people in your household that are there, it makes a lot of sense that people would end up trying to use a strategy that would protect all of us.
All right, we're going to have to leave it there. Dr. Manish Garg, thank you so much. The global chip shortage is about to hit the iPhone. It's a sign that even some of the largest, best supplied companies can no longer sidestep the semiconductor crisis. Apple posted blowout earnings yesterday, but not without a warning. The iPhone maker said the chip shortage would extend to its smartphones this quarter and slow revenue growth. Joining us now to talk about it is Wedbush Securities Analyst Dan Ives. Dan, good to see you. It has been a while. You called this another drop the mic quarter for Apple, but what about this warning about the chips? Comes at a really bad time. They're looking to roll out that new iPhone in the fall.
Yeah, and the chip shortage, you know, it's an overhang not just for Apple, but every automaker and technology player out there. But at the end of the day, it's a rounding error relative to what it's going to do from a supply perspective over the next 1 year, 18 months. I mean, they're in the midst of a super cycle. So we could be talking about 3% of demand, maybe moves out from September to the December quarter. Take a step back, gold medal performance last night in terms of that performance, $5 billion iPhone beat. Considering the chip shortage, it just shows the demand continues to be underestimated by the street. We still think a year from now, we're looking at a $3 trillion market cap.
Curious to know, Dan, speaking about that demand, now that we have, the iPhone 13 coming out, now Apple hasn't really indicated that there's going to be any delays, so expecting that to be, I believe, right on schedule, so around the end of September. What are we, or what can we anticipate for the demand, at least when it comes to the iPhone, the new iPhone that they have? Because this is a segment that we have seen, at least previously, Apple has started to falter in.
Yeah, if you look at iPhone demand, especially over the last year, I mean, that's what significantly beat along with services. I think when you look out over the next year, our supply chain checks going to iPhone 13, it shows that underlying units could be up 12, 15% from iPhone 12. So I think that continues to be the most important point in terms of this elongated super cycle playing out. Remember, it's the 1-2 punch, because the services, we think that alone is worth $1.5 trillion. It's part of this re-rating that we're seeing in Apple. Remember, if you go back, the skeptics continue to say the innovation's in the rearview mirror, and ultimately the growth is too. You're seeing a renaissance of growth in Cupertino, and that's why this is a stock, in my opinion, on its way to a $3 trillion market cap.
And we should mention you maintain your outperform rating on Apple. You've got a $185 price target. I want to switch gears for a moment and talk a little bit about Microsoft because total revenues came in at $46.2 billion, absolutely blowing it out of the water. Again, we continue to see strength in their growing cloud business. Why are you so optimistic about the Microsoft story, Dan?
Yeah, and that continues to be the cloud. I mean, if you look and you take a step back, only a third of enterprise workloads are in the cloud today. We think going potentially 70% in the next 3 years. Microsoft, and as well as Amazon AWS, and we'll see that tonight, is that continues to be a disproportional beneficiary when you look in terms of move to the cloud, what they're doing with Azure as well as Office 365. And that, in my opinion, is a $1 trillion market opportunity. It's not just Microsoft, it's Amazon, Google, and others. But that's part of the re-rating that you're seeing in Microsoft. Disproportional benefit of cloud. They right now are really in a massive position of strength. And that's what you saw last night with just those jaw-dropping numbers.
But Dan, looking out ahead, to the next couple of quarters, what kind of sustainability really are you seeing for some of these figures?
Yeah, and when they talked about Azure being similar growth into next quarter, and everything we see from our checks, talking to customers, talking to enterprises, we're just hitting the next gear of growth in terms of cloud. And I think that's really been the misnomer, in my opinion, in tech, is that many view it COVID pull forward, no doubt. Zoom, Citrix, a lot of the collaboration names. For Microsoft, I think this is a massively underestimated digital transformation. And that's why I think it's one where, as this continues to play out, we can see double-digit growth, and it's when they're going to continue to defy expectations, which is why this remains our top cloud pick.
I want to ask you quickly about Tesla before we let you go, Dan, because I know that you also watch Tesla very closely. And we see that company also being impacted by the computer chip shortage, as are many, many companies. And Elon Musk came out Monday and actually said it might affect the timing of their Cybertruck, which we've been waiting quite some time for. This week we saw Lucid Motors, or I guess it was late last week, saw Lucid Motors go public, yet more competition for Tesla. What would it mean for Tesla to hold off on bringing that Cybertruck to market?
Yeah, and look, in terms of the chip shortage, I think that was sort of the glass half empty view post-quarter. It's something where it's really out of their control. You're going to see some of these delays, but it could be 3 to 6 months. It doesn't change the overall green tidal wave story, especially now for a company that's starting to be profitable, actually selling cars rather than just EV tax credits. Last year was a Cinderella story for the stock. This year's been underperformance. I view it as just a digestion period. A year from now, we still have a $1,000 price target. And this continues to be, it's a big enough ocean for more than one boat. You're going to have a lot more competition, but it's only 3% of auto today is EV. So there's going to be massive winners, and we think Tesla kind of leads the charge.
All right, Dan Ives over at Wedbush. Thanks so much. Appreciate your time.